The U.S. yield curve inversion is upon us. Maybe you could give us, CP, a little primer on what this means, the inverted yield curve, and why people are talking about it this week.
Well, I think people, were talking about it. The reason they were is that they believe that it predicts a recession.
As if global unrest over the invasion of the Ukraine, new COVID lockdowns around the world, and continued supply chain tangles weren't enough, now the markets have another red flag to contend with. Late Thursday, after flirting with the milestone for days, the bond market's yield curve inverted. The yield on the 2-year Treasury was at 2.337%, while the yield on the 10-year Treasury fell to 2.331%, turning the spread negative. The inversion is a warning signal that the markets are expecting the economy to worsen and serve as a fitting end to the worst quarter for the S&P 500 in 2 years. The yield curve plots the yield of all Treasury securities. Typically, the curve slopes upwards because investors expect more compensation for taking on the risk that rising inflation will lower the expected return from owning longer-dated bonds. That means a 10-year note typically yields more than a 2-year note because it has a longer duration. Yields move inversely to prices. A steepening curve typically signals expectations of stronger economic activity, higher inflation, and higher interest rates. A flattening curve can mean the opposite. Investors expect rate hikes in the near term and have lost confidence in the economy's growth outlook. What does an inverted curve mean? Investors watch parts of the yield curve as recession indicators, primarily the spread between the yield on 3-month Treasury bills and 10-year notes and the U.S. 2-year to 10-year curve. The U.S. curve has inverted before each recession since 1955, with a recession following between 6 and 24 months, according to a 2018 report by researchers at the Federal Reserve Bank of San Francisco. It offered a false signal just once in that time. According to Anu Gaggar, global investment strategist for Commonwealth Financial Network, who looked at the 2-year to 10-year part of the curve. There have been 28 instances since 1900 where the yield curve has inverted. In 22 of these episodes, a recession has followed. The lag between curve inversion and the start of a recession has averaged about 22 months, but has ranged from 6 to 36 months for the last 6 recessions, she wrote. The last time the 2-year to 10-year part of the yield curve inverted was in 2019. The following year, the United States entered a recession, albeit one caused by the global pandemic. In this video, Chamath and other members of the All In podcast in a recent podcast shares their views on the inverted yield curve and what it means for the U.S. economy. Before we listen to Chamath, we want to give a big shout out to all our viewers and subscribers. Thank you so much for watching our videos. Please smash the like button and subscribe if you are yet to do so.
Well, I think people, were talking about it. The reason they were is that they believe that it predicts a recession. And specifically what they look at is the interest rate on a 2-year bond and an interest rate on a 10-year bond, and you subtract one from the other. And when it inverts, what it means is that, typically in a healthy economy, you want rising interest rates over a long period of time. And the reason you would want that is that you are guessing that the economy will be healthy. There'll be a nominal amount of inflation, so things will tentatively increase in price. And as a result of that, you need to get paid more for the future than today, right? So if you want me to take 10-year risk, you need to pay me a little bit more than if you want me to take 2-year risk. And so things should go up and to the right. But when all of that stuff 10 years out, all of a sudden is trading for a lower yield than today, what people think will happen is that, governments will cut interest rates massively. They tend to do that in order to stimulate the economy, right? To get money back into the system. And they tend to do that because of a recession. And so people look at the difference between the 2-year bond and the 10-year bond, and they try to guess what's going to happen. Here's the problem with all of this. It turns out that it's not as correlated as one thinks. And Nick, I posted this link, so you can just put it up there. But a bunch of economists at the Fed actually went and, you have access to this data. They back tested this. And what they found was that there was actually a more predictive signal of recessions, which is the difference between the 3-month T-bill and the 18-month T-bill. And if you look at the 3s18 spread, they call that the forward spread at the Fed. That's actually not showing a recession at all. In fact, that shows a very healthy ascent, largely taking into account the fact that the Fed has told us that they're going to rip in a bunch of rate increases over the next year to 18 months. So what are we to do with all of this? Well, when there's been a recession, it has typically been true that both the 2s, 10s and the forward spread have collapsed to zero or gone negative. That's this inversion. It has never really been the case that 2's 10s inverts while the forward spread stays up and you have a recession. In the past, we've mentioned that when oil has these kinds of price spikes, it typically forecasts a recession. So if you put all of this data together, it's a really murky picture. So what are you supposed to do? It's not totally clear to me, but I think the general way that I think the market is reacting to this is probably inappropriate, and I'll tell you why. And the setup, by the way, because of this inappropriateness is actually quite interesting. So why is the reaction inappropriate? Look, if you think about where we were in November and where we are today, we've had massive exposition of inflation. We've had massive disruptions to the supply chain. We've had the beginning of a war whose end is somewhat indeterminate today. That's causing a bunch of spikes in a bunch of really critical commodities the entire world needs. We've had a Federal Reserve that went from hiking 50 or 75 basis points to hiking 200 to 250 basis points by the estimated average. And so all of these things have happened, yet the market is basically at an all-time high, plus or minus 5%. That really doesn't hang together at some really basic logical level, right? So what's going to happen? Well, Brad said this last week. What has actually happened under the hood is a dispersion, which means the crappy companies have gotten crushed and the good companies have gotten whacked, but not crushed. Okay? And then when they rally disproportionately in favor of the good companies. So what are we doing right now? I think we are going to see this diversion of companies, and we're about to go through earnings season, right? We're at the end of Q1. And I think what's going to happen is really interesting. You're going to have a handful of companies who have a great handle on their business, who actually project strength. I know what I'm doing. I know how I'm going to perform. The levers are in my control. I'm going to invest for the future. I'm going to go and consolidate a market. Those companies will get rewarded. And then anybody else who has a whiff of indecision or whose structural business is flawed, and then they use all of these other issues as a reason to explain their flawed business, will get completely whacked.
Jason, the host of the podcast, defined what a recession is. According to him, just to clearly define it, a recession is 2 quarters or more of negative growth, the economy contracting, and we've had about a dozen of these since World War II. We remember a couple in our lifetimes. Obviously, the COVID situation created a recession for a couple of quarters. And then we had the Great Recession, which lasted, I think, over a year. Right, that was 6 quarters, I think. 5 quarters. So these happen every 10 years or so. So if we do have a recession, and it seems implausible to me that we would have negative growth for 2 quarters. Let's listen to him.
Cut spending. Increase government spending. Cut taxes. Where are we at in terms of how many bullets we have left to do these kind of things? We don't really have a ability to spend more money. And I guess lowering interest rates is the other way to stimulate it. Do we even know we're going into a recession? So do you think we're going into a recession? If we are, is there a way to reverse it through the normal tactics?
We're definitely going into a slowdown. And whether it becomes a recession is to be determined. I think there's a very good chance because we already were headed for a slowdown because of interest rate increases, because of inflation. And now on top of it, we've got all the supply chain disruptions from this war. And we know that, unplugging the 144 million Russians in the Russian economy, we've basically unplugged that from the global economy. So that's going to hit our economy. There's a little bit of a delayed reaction there. So these are all negative indicators. And I think we're either going to have a recession or something very close to it.
And they typically last 11 months, right, Sachs? So how long would the recession be? You think it's typically 11 months, 2 quarters,
I guess normally,
6 quarters?
Yeah, normally it's like 18 months till you get back to where you're supposed to be or something like that. But you're right. We have very limited tools to fight this because we've already we've already broken the glass in case of emergency for COVID. We spent something like 10 trillion. By the way, that's what caused a lot of the problems is we flooded the zone with liquidity. Now we're trying to mop that up with interest rate increases. That's slowing down the economy. So there's nothing left to really spend. You can't really drop interest rates much more. And if you do, you'll get much worse inflation. So it seems to me that we don't have a lot of tools here, and we could end up with something like a 1970s style stagflation, where we continue to see inflation with a slowing economy.
Economy headed for a recession? Economists, as always, are mixed on this question. On the hawkish side are those who've been warning for a while that inflation was getting out of hand. The Fed has been consistently overly optimistic about inflation coming down, and it's really behind the curve, said Peter Morrisey, a professor emeritus at the University of Maryland. Because the Fed waited so long and let inflation get so high and pervasive, he said, it's going to have to do more than raise interest rates 0.25 percentage point every month or two to slow the economy down. We've never really had this kind of inflation without causing a recession to bring it under control, Morrisey said. There's a fair amount of skepticism out there that the Fed can effectively navigate the tumultuous global economy and geopolitical situation. Basically, we're asking the impossible out of the United States Federal Reserve, said Joe Brucelas, chief economist at consulting firm RSM. By expecting the Fed just to cool inflation but not stall growth, he said. That's well-nigh impossible, considering Russia's war on Ukraine and soaring oil prices. Oh, and pervasive uncertainty, a pandemic that's not yet finished, another supply shock. All while we're having essentially 8% inflation that's likely to crest above 10%, Brucelas said. He puts the chance of a recession over the next year at 1 in 3, higher if the war in Ukraine spreads. Most economists rate the chances of a near-term U.S. recession at significantly less than even odds. That's despite the outlook for Europe and the global economy continuing to deteriorate. Eric Friedman, chief investment officer at U.S. Bank, expects an economic slowdown here, but nothing worse. Though there are risks to that outlook, he said. A faster tightening of monetary policy by the Federal Reserve that has a spillover effect into the broader economy, persistently high energy costs, and a resultant dampening of consumer and business activity. Many economists remain optimistic that the Fed will be able to engineer a so-called soft landing, taming inflation and restraining demand without reversing the economic recovery. We will love to hear the opinions of our viewers on this topic. Do you think the inverted yield curve will lead to a recession? Let us know in the comments. Thanks for watching.